What is up, YouTube? I'm Adam O'Dell, Chief Investment Strategist at moneymarkets.com, and I'm joined by my research analyst, Matt Clark. And we're here for another episode of Ask Adam Anything, where you can ask me anything and I'll give you my take on it. So feel free to leave a question in the comments below, or you can email myself and my team as well. We basically try to get back to as many questions as we possibly can. And Matt, I understand that the issue in Russia and Ukraine is at the top of everyone's mind. So I believe you have a question related to that, but I'll let you put it up there.
I do, and thanks for doing this again this week. And yeah, absolutely. And by the way, before I start, I do want to encourage everyone to check out moneymarkets.com. That way, there you can actually use Adam's proprietary green zone rating system, and you can get the rankings of any number of thousands of stocks across the market. You can find out how they're broken down. Check out their metric rankings, their overall rankings. You have a full picture of any potential stock you want to invest in. You can set up a watch list and do all that as well, track their green zone ratings that way. You can do all that for free at moneymarkets.com. If you do have a question for Adam, myself, Charles Sizemore, email us at email address feedback@moneymarkets.com, or you can comment down below here on YouTube. But yeah, Adam, everything you see in the news, it's Russia, Ukraine. What's going on here? What's going on there? I honestly, as a news junkie and as a former news person, I'm refreshing news sites just to kind of see. There's a lot of news sites that are doing a very good job kind of updating how the course of events globally, and it's kind of a nice resource to have. I get to look at it now from a different perspective, which leads me into the question I have for you. But first, let me preface. When Charles Sizemore and I sat down and did investing with Charles last week, I pulled a few interesting stats, and what I looked at was how the U.S. market, both the S&P 500 and the Dow, performed during a couple of similar events. Not necessarily all-out war, which is kind of the lexicon that we're using now in relation to Russia, Ukraine. Is it? No, but it can be considered that, especially if you're in Ukraine or if you're in Russia, it is. But outside the global perspective, it's not. However, so I looked at not wartime, but more specific global event. And one was in 1956, November 4th. This is when Soviet tanks crossed the border into Hungary to put down a protest that was trying to liberate the country from Soviet rule at the time. The second was in 1962, when John F. Kennedy and Russian and Soviet Premier Nikita Khrushchev were involved in a very tense standoff involving the Cuban Missile Crisis. And in both instances, what happened in the market was a brief pair back in both of those indices, followed by a very nice run up. And the drops were, I think you and I were talking about this offline, in 62, after the Cuban Missile Crisis, the pair back was about 6%. And in 56, during the Soviet rolling into Romania, it was, I believe, about give or take 1 to 2% total. And then after that, both indices took off over a period of time, a little bit longer in 61 to 63 than in 56 to 57. So to lay all that out, I'll stop talking and ask you, talk about what markets have done in times of these kind of military operations. I hesitate to call it a war. I know that's common, but again, I think in terms in this type of a geopolitical structure, what have markets done in the past?
Yeah, well, first of all, regardless of whether they call it a war or an invasion or a geopolitical event, people are dying, and certainly we want to have empathy about that. As my wife likes to remind me, it's not all about the stock market. So we certainly hope that the conflict is resolved quickly and with as few casualties as possible. But yeah, we're stock market strategists, so we do have to talk about, and we have our own clients and subscribers writing in, asking us, what effect is this going to have? I'm reading about this in the news. Should I be worried? Should I sell my stocks? Should I, buy defensive assets, things like that? So we do have to answer these questions, even though it's a sensitive subject. And if you look back, really the stock market's reaction to wartime and even shorter periods of geopolitical turmoil, the reactions of stocks are actually very counterintuitive. You think that stock prices would go down, volatility would go up. You would think that U.S. Treasury bonds would catch a bid and go higher as a flight to safety. And really, that's not the case. The simplest way to put it is that the stock market tends to shrug off these types of events. So you mentioned two of the events, the Cuban Missile Crisis and the uprising in Hungary. But basically, I've got a table here in front of me with probably 24 geopolitical events, everything starting from the attack on Pearl Harbor in 41, the Suez Crisis, the Yom Kippur War, the Madrid bombing, the bombing of Syria, so basically, everything to current day. And there is a wide dispersion between these events. And what I mean by that is some of them are kind of short-term events and they have an effect on the market over a 1 to 5 day period. And then some of them, obviously, like the Iraq's invasion of Kuwait was a much longer term event. So there is a lot of dispersion here that, the devil's in the details. So you want to kind of be tactical with your approach to trading the market. But generally, the average drawdown of maybe 20 some events like this has been 5%. There have been drawdowns of 12% during the US terrorist attacks in 01, the 9/11, drawdowns of 17% during the start of the Iraqi war. And then when North Korea invaded South Korea in 50, there was a drawdown of 13%. Pearl Harbor attack was a drawdown of 19.8%, so nearly a bear market. So I don't want to say that stocks never react to events like this, because that would be not accurate. But in general, the averages show an average drawdown, a max drawdown of 5%. And the market tends to take about 22 trading days to find a bottom and about 47 trading days on average to recover to new highs. So typically, again, the markets will shrug off the events like this. You can also look at averages across all of the wars for large cap stocks, for small cap stocks, and for bonds. And again, this is where it's counterintuitive. Large cap stocks over all years between 1926 and through 2015 is the data that I have returned 10%. During war periods, they've returned almost 12% with less volatility. Same thing with small cap stocks. All years returned 11.6% during war periods. They've returned 13.8% with about half the volatility. The bonds really surprised me because I would have thought that bonds, catch a bid as a safe haven asset, but bonds tend to underperform during times of war. A lot of that probably has to do with inflation. Inflation is statistically, on average, higher during times of war. All periods, it's about 3%, and it's about 4.4% during times of war. So that actually, keys in well with what we're seeing now. We're already seeing inflation over the last 6 to 8 months. So this event is probably only going to exacerbate that, no matter how long it lasts. There's also the issue with, Russia is a large exporter of oil and gas. So to the extent that any of their infrastructure is taken offline, or even their disruption of the shipping channels around them, could lead to further inflation, both in the energy complex as well as the agricultural and other products that get shipped around the world. So we could, that could basically provide a tailwind behind the already in place inflation that we're seeing. So two take-home messages here. Basically, don't be scared out of the stock market just because we feel like this war type conflict is going to cause problems. Generally, markets are resilient to these types of periods. The other take-home message is look to commodity markets and look to the energy sector. The energy sector is the only sector of all the sectors you and I track, Matt, that is up year to date. So XLE, the S&P energy sector ETF, is up 20% year to date, and all the rest of the sectors are down. So I've been beating the drum on the old dirty oil and gas sector for about 18 months now. We've made a number of tactical plays and home run profits, as well as green zone fortunes. And really those energy sector plays are really doing well in this environment. So there are spots to really make outsized returns, even if the rest of the market's a little bit shaky for now. But again, we think it's going to be resilient and recover from here. I can't say that the bottom is definitely in, but we are certainly watching things closely and communicating with our subscribers.
And that actually now was going to answer the follow-up question I had, and that was, in terms of looking at individual sectors, obviously oil and gas is a very big industry in Russia, and they are going to pay. Nord Stream 2 has been shelved for the time being. That was a big revenue generator, potential revenue generator for Gazprom, which is the state-owned gas company that operates Nord Stream 2. But there is some concern in terms of how that might affect consumer prices here in the U.S. So I guess to pivot away from what I was going to ask you, and that was what sectors do you think we should look at, because you already answered that. Let's talk about what kind of reverberation this conflict may or may not have on prices here in the U.S.
Well, it all depends on basically the extent of the damage to the infrastructure. If this all takes place in Ukraine and it's a short conflict, then we might not see any impact whatsoever, or just a psychological, expectations-based impact. That said, if this persists for many, many months and a large portion of Russia's energy infrastructure is taken offline, if their production starts to decrease rapidly, then we could see certainly large spikes in energy prices. And then there's kind of a knockoff effect. Energy prices make shipping other commodities around the world more expensive, so they're going to pass those prices on to consumers. I'm talking like large exports like wheat. Russia's a large exporter of wheat. So things like that. So it really just depends on how long it lasts and the extent of the damage to the infrastructure and the shipping channels and ports that move these commodities around the world.
So really the takeaway here is, and I think you said it very well, is don't panic sell, but also don't panic buy either. I mean, it's very important to, we've talked about this in other videos. You and I have, Charles and I have, I've done it with our podcast. And that is, if you have a plan, stick to that plan. Your stop losses don't change because of a headline. So if you have equities in your portfolio, you have stop losses set for those equities. They're not going to change. If they go down, they meet the stop loss, you execute the sell. It doesn't change based on a headline. And the markets are going to fluctuate. They have already. We saw a downturn on Wednesday. We expected a downturn on Thursday, and there was a downturn for about the first 3 quarters of the session before a rally in the afternoon. On Friday, stocks opened up higher. So there's always the unexpected, and just stick to your system. And if you don't have a system, I would encourage you to check out Greens on Fortunes. This is our flagship product. Adam, Charles, myself, and our entire team, we give you in-depth analysis, insight into the market, and we provide you with those stocks that we feel are going to beat the market 2 to 3 times over the next period of time. So you want to find out more about that, we'll give you a link up top, and you can click to find out more about Greens on Fortunes. Also check out moneyandmarkets.com. That is where we all provide you safe, sound, smart, simple, profitable investment information for your portfolio. I'll spit it out. Adam, that's all I have for you. I think you answered all the questions very succinctly and nicely. And again, the takeaway: don't panic buy, don't panic sell. Follow your system, follow the rules.
Absolutely.
Follow the rules you set up. And
it's very great wisdom that you share there. I mean, the thing is, you do want to be adaptive to the markets. That's something we do, but you don't want to be reactive to them, meaning you don't want to react to one day's worth of headlines or price action. You said it best Thursday. I mean, the market opened lower. It was down, NASDAQ was down 6-7% at one point at the lows, and anybody and gold, I mean, GLD was up, huge. And then if anybody had made trades in those trends as of Thursday morning, they would have seen those trades absolutely reverse on them and rip their face off come Thursday afternoon and Friday. So the thing is to adapt to, short to medium term moves, but don't react to one-day headlines and whatnot. So you said it very well, and follow us at Greens on Fortunes or Home Run Profits, and we like to kind of help our readers navigate these environments. So, but otherwise, thanks for having me on again, Matt.
Yeah, appreciate that. And again, if you have any questions for Adam, Charles, or myself, you can email us feedback@moneyandmarkets.com. We'll flash that down below, or you can comment below here on our YouTube channel on any one of our video series. We'd love to get your feedback, love to answer your questions. So ask away, and we really enjoy that. Adam, appreciate it. Look forward to doing it again next week.
Thanks a lot, Matt. Take care.